All right, let's jump right into this explainer and uncover a massive macroeconomic mystery that is quietly draining your wallet right now. It's a story that usually gets completely buried under political shouting, but today, we are just looking at the math. We're going to map out exactly how an invisible machine is working behind the scenes and why understanding this structured flow of money is, frankly, the only way to protect yourself.
I want you to picture this scenario for a second. You've got your rate lock page open on your phone. You refresh it on a totally quiet Tuesday morning, and suddenly, the number turns red. Nothing obvious happened out in the world. The Federal Reserve didn't hike rates, inflation didn't suddenly spike, and the latest jobs report was completely boring. Actually, scratch that. It wasn't just boring, it was totally standard. Yet that little red number just added about $130 to your payment every single month for the next 30 years. So why did it move?
Well, you might be wondering if the answer is in Washington, D.C., but it's not. It's actually sitting at a desk thousands of miles away. Meet the man in Tokyo. We'll call him Kenji. Kenji manages money for a massive Japanese institution, and his job has historically been incredibly boring. But as you'll see, Kenji is currently making one small, highly reasonable decision at his desk that is quite literally reaching across an ocean to pick your pocket. To understand how he's doing this, we first need to look at the numbers he's dealing with.
So let's talk about the giant number everyone is always obsessing over. $39 trillion. That's the size of the US national debt right now. It's an absolutely absurd number, right? It's so massive it almost stops meaning anything to our human brains. But honestly, I want you to completely forget about the sheer size of it for a moment, because the raw size of that number isn't the real danger here. The real danger is the compounding machine humming right underneath it.
This is the number that actually matters. $1 trillion. That's what it currently costs just to pay the interest, essentially the rent, on the money the government has already borrowed. When the government can't cover its spending, it borrows. That borrowing adds interest, which gets added to the spending it couldn't cover in the first place, forcing it to borrow even more. We are literally watching the exact financial position of a person paying off their credit card minimum with a second credit card, but, on a national scale.
What really gets me, though, is the sheer speed of that compounding. To hit that $1 trillion mark, the United States government has to borrow $32,000 every single second. Just in the time it took me to say that sentence, the government borrowed more than most people make in an entire year, purely to pay interest on old money.
And the math points out a wild tipping point we've just crossed. The United States now spends more every year servicing its debt than it spends on its entire military budget. The most expensive, technologically advanced military in human history is now a cheaper line item than the interest on our past borrowing. We are literally paying more for yesterday than we are paying to defend tomorrow. Let that sink in.
Now, you might be thinking, okay, this just sounds like some fringe internet doom scrolling. But no, it's really not. The people who run Wall Street's biggest banks and hedge funds are starting to say this out loud. They're quietly pointing out the cracks in the system, calling this the single biggest threat facing the country, and warning that we are walking toward a moment where the math simply stops working. When the people profiting the absolute most from a system start getting nervous, yeah, we need to pay attention.
So, what does this actually mean for you, sitting at your kitchen table? Well, if you take that $1 trillion interest bill and spread it across every household in the country, it comes out to roughly $7,000 to $8,000 a year per family. You're never going to get a direct bill in the mail for this. Instead, you pay it in 100 small, hidden ways that you'd never intuitively trace back to the national debt.
For years, none of this really mattered because there was a totally reliable floor under the US Treasury market. And that brings us back to Kenji. For a whole generation, Japan kept its own interest rates near zero. So Kenji naturally sent his money across the Pacific to buy US Treasuries, literally the safest asset on Earth that actually paid a return. But in 2025, Japan's central bank finally ended its free money era and raised rates. Suddenly, Kenji could earn a safe return right at home. He didn't panic, he didn't dump his US bonds, he just politely decided to buy a little less and keep more money in Japan.
Now take Kenji's calm, highly rational decision and multiply it across an entire generation of foreign money. The US lost its most loyal buyer right when it needed to borrow more than ever. But here's the real twist. Those patient, boring institutions playing the 30-year game stepped back. And who replaced them? Nervous money. Hedge funds, asset managers, leveraged traders. We basically swapped our calmest shock absorber for hair-trigger buyers who will hit sell before lunch the moment a scary headline drops.
And this creates a direct chain reaction right back to your wallet. Think of it like a giant financial seesaw. Step 1, buyers like Kenji buy fewer treasuries. Step 2, because there's less demand, the price of those bonds falls. Step 3, when a bond's price falls, its yield, the interest it pays, goes up. And step 4, because American mortgage rates are built directly on top of that 10-year treasury yield, your mortgage rate climbs right along with it.
The crucial takeaway here is that economists have calculated a single big month of foreign selling can shove U.S. yields up by more than half a percentage point. Drop that onto a normal home loan, and boom, that is exactly where your extra $130 a month comes from. That is the very real, hidden cost of a guy in Tokyo making a boring decision at his desk.
But hey, this pressure isn't just coming from across the ocean. It's actively building right down your street. Meet Rosa. She's a loan officer at a regional bank in a mid-sized American town. Rosa is sitting on a slow-motion problem because her bank holds a massive pile of commercial real estate loans. We're talking office buildings and strip malls that were financed years ago when rates were practically zero.
Today, those buildings are half empty, they're worth dramatically less, and the math to refinance them at today's higher rates simply does not work. So what does Rosa do? She uses a strategy the industry literally calls extend and pretend. She pushes the loan deadline out a year or two just to keep it looking healthy on paper, praying conditions magically improve. But across the whole system, these quiet losses are piling up in the dark, forcing banks to tighten credit for the small businesses and homebuyers who actually need it.
So now you have Kenji squeezing from abroad and Rosa squeezing from home. This is usually the part where people tell you to go buy gold and build a bunker, right? But look, the US is not Greece. A country that borrows in a currency it also prints literally cannot be forced into a sudden, explosive default where they just run out of cash. The US has a cheat code. They can always print the dollars. Because of that, our collapse isn't an explosion, it's an erosion. And there's actually a polite academic term for this kind of erosion. Financial repression. It's literally the oldest move in the playbook for governments with a mountain of debt. They don't miss a payment, no way. Instead, they pay every single bill right on time, but they keep interest rates just a hair below inflation. This slowly shrinks the debt in real terms, while quietly melting your savings. The debt gets paid down, it's just paid down out of your bank account in slow motion, so you end up blaming the grocery store instead of the government. Plus, there is a secondary effect to this erosion, a massive crowding out. That interest slice is actively eating the rest of the budget. Every dollar torched on interest is a dollar stolen from defense, from fixing your roads, and from the social programs you and your family rely on. The debt starts paying for itself, and you just get whatever is left over. You are the repayment plan. You just never got a say in it.
But to keep this whole thing going without setting inflation totally on fire, they've built a massive backstop. The Federal Reserve has quietly created what is essentially a permanent pawn shop for entire countries. Foreign central banks can now hand over their US Treasuries as collateral and just walk away with cash. This was supposed to be a temporary 6-month emergency tool during the pandemic, but now it's permanent furniture. When you use the emergency exit every single day, it stops being an emergency exit and just becomes the floor everyone is standing on.
So, let's wrap this all together. Loyal money is drifting home. Nervous buyers have replaced them. The interest is compounding way faster than the economy can grow. Emergency tools are now completely permanent, and your dollars are actively buying less. The absolute most important takeaway here is that none of this is some dystopian future forecast. It is a snapshot of right now. The beginning of this shift has already happened, driven by perfectly reasonable people like Kenji and Rosa making sensible choices in a system that is fundamentally changing.
Which leaves us with a really big, vital question. Now that you can clearly see the invisible machine eroding your wealth, that growing gap between your raise and your rent, what are you going to do? The people who understand the game being played are historically the ones who don't end up paying for it. So, will you use this understanding to position yourself? Or will you just accept a slightly higher payment every single month for the next 30 years, quietly funding a system you never even realized was there?